Hello, everyone, and welcome. I'm so glad to have you here with us today for Intro to Venture Investing with 1000 Angels. I know we had a lot of new people sign up today, so I just want to remind everybody that this is session 4. And if you missed the first 3 live sessions, you can always watch them on our YouTube channel at your convenience. So thank you so much for joining us today, for joining us live. One of the benefits of joining in live is that we do have this really great Q&A feature and a chat feature. So if along the way you have any specific questions that you'd like to ask me about the materials that we're covering, you can always chime in and do that. So without any further ado, let's get started. We have half an hour to cover quite a bit of material, but don't worry, whatever we don't get finished today, we will have the chance to continue covering during session 5. So what we're going to be going over today is what we call the investment process. So I'm just going to enlarge my screen here so you guys can see as much as possible. And this is usually a really exciting topic for folks who are new to the concept of early stage investing, right? So they want to know exactly what is it that we do. So we talked a lot in sessions 1, 2, and 3 about the types of companies that we invest in and what we're looking for in a company in order to be considered a candidate for investment. During today's session, we're going to get started digging into the actual process of making an investment and, how do we begin from sort of A all the way to Z. So really the process for us begins, when an entrepreneur requires capital, right? So there are several different stages in the life cycle that a founder is going to require capital for their business. At startup, during the growth stage, often for liquidity. If the company wants to be able to provide some liquidity to investors or founders, or if the company is looking to grow through acquisition. So there are many different types of stages where companies require capital. And of course, at 1000 Angels, what we're really focusing on is that startup phase and maybe also participating in some of the early growth rounds. So an entrepreneur has various sources of capital to consider besides you guys as investors. So in the beginning, they're usually using personal funds. They're raising money from friends and family. They may have access to grants from various institutions, funds, or nonprofits. A lot of this type of funding can actually be really beneficial, not only to founders, but also to investors because it's typically non-dilutive. Certain types of companies have the ability to get loans from banks or the SBA, but generally that's pretty difficult because if you are a sophisticated investor, you're probably already familiar with the fact that banks tend to only loan based on asset value, and unfortunately, most of these startup founders don't actually have any assets in their company, right? Which is why they need now to raise a much more expensive form of capital, which is equity. And this is where we come in and where we actually develop opportunities to, invest in particularly high return assets because, borrowing money just isn't really an option for companies at this stage. And so the various types of equity investors that a company is going to pitch to or maybe raise money from over the course of its life include angel investors, venture capitalists, and private equity firms. So at 1000 Angels, we pretty much sit, we really straddle that gap between true angel investors and venture capitalists. So, we're really coming in during what we would consider a professional seed round. And so why this is such an important stage in the company's funding cycle and why it's so important that we're there is that it's actually very, very difficult to find people who are interested in funding your company kind of between that friends and family round and where people might consider, traditional non-professional angels participating in a round and to the point where a company gets to maybe a Series A where a later stage VC is going to be involved. So by coming in at that, sort of first formalized seed round, you can get the benefit of not only a deal that has better structure and protections that it might be similar to what a VC might negotiate, but you're still at an extremely attractive valuation that allows for significant upside for the company. By the time the company is getting to the point of raising equity from private equity firms, you're typically going to see much larger amounts of capital being deployed. So this would be, raises of kind of, $25 million to $100 million, maybe even more. A lot of private equity firms are typically taking a control position. So, it can even be in the hundreds of millions of dollars. And generally the valuations are now, much farther up there. And there's even a possibility of liquidity either for founders or for some of the early investors. So that's just a generalization, and we'll go through the specific stages in a bit more detail in a moment. So this slide is great, and if anybody's interested in getting the slides, just send me an email after, and I'm happy to provide you with the slides. It's Erica, ERICA, at 1000angels.com. So this slide is interesting because it shows a little bit, it gives you a way to see how we use different types of securities and different types of vehicles or firms to make investments in companies during different phases. And I think that one of the things that as an individual accredited investor that I can help you understand about what we do at 1000 Angels is to really see where you would actually have the opportunity to invest, right? So typically when a company is in what we call the pre-seed phase, this is kind of also known as pretty much like the friends and family round. So usually, this is before they really have any traction. And, terminology can vary from company to company, but what I would consider kind of a pre-seed or friends and family round, typically, these investors are getting common stock. Founders are coming in using their own money. They're getting founder stock, which, the difference between common stock and founder stock is that the founder stock is actually vesting usually over time. So if you have 3 different founders who are all interested in, starting a business and they want to split the equity equally, they have to also agree that their stock vests at a certain rate, usually over kind of like a 4 or 5 year period, in order to conserve the total equity of the company. And the types of investors that you're going to see in this sort of round are like friends, family, the founders using their own money. And I think that this is really key because a lot of inexperienced investors sometimes get into their heads that they should be participating at this stage. And, I think that unless you truly are a friend or family of this person, this is not for you. We don't really do pre-seed rounds under any circumstances, right? Because there's just far, far too much risk. And so, where we're coming in as investors, I always like to say that people think that, this is, such a risky asset class. And I say, well, if you know what you're doing and you know the right time to come in at an investment, and you also, perform a lot of due diligence on the management team and the opportunity, et cetera, the vast majority of the risk that we deal with is really much more around liquidity and timing. So it's not so much that, the companies are so pie in the sky that the equity's, very likely to be worth 0. It's more that the equity will be worth something, but we have no idea when we'll actually have an opportunity to get liquidity, and it could be a year from now, or it could be 12 years from now. And so, for most people, just the way that they're living their lives, you're not an institution, you're a person who's saving and building growth for the future, that presents a certain level of risk. So that's the way that we really kind of think about our risk. So the next stage is where we actually like to start making investments in companies. So typically any company that we work with at 1000 Angels is either in a seed round or a Series A. I personally prefer to start with companies at the seed round because my specific expertise is really in identifying companies at this stage that are going to have significant value evolution. And even by the time, a company gets to Series A, you're in a little bit of a different spot. So typically when we invest in a company at a seed round, the valuation of the company is usually somewhere between $4 and $6 million. It could be as low as $3 million. Which is great, but it just really kind of depends on quite a few different factors, as well as, sometimes the geographic region where the startup is located. So, for example, a lot of startups that have come out of, cities like Cincinnati or Detroit, where they're a little bit more depressed, end up with valuations on the lower end. And, startups that are in a seed round, coming out of, say, San Francisco area or New York or some other place with a pretty robust startup ecosystem and financing ecosystem will tend to have startup pre-money valuations for a seed round of closer to like $5 or $6 million. But a lot of this is based on what the company has actually accomplished, as well as just market forces. So for a seed round, the typical investment security that you're going to see being used, and a seed round is usually around $1 million of capital raised. So you're going to see what we call the SAFE, which is a simple agreement for future equity. Losing in popularity, but a very similar document is also the KISS, which stands for Keep It Simple Security. The SAFE and the KISS were invented by Y Combinator and 500 startups, respectively. The reason that they created these two particular very standardized documents is because they end up sometimes making hundreds of investments in any one year. So they wanted a really standard, really cheap, really easy to use legal document that they could use over and over again for hundreds of startup investments. And, the creation of these vehicles has actually been beneficial just in general to the startup community, because when a company is, raising $1 million, spending $50,000 on documentation for the round is, 5%, right? It's like a pretty significant portion of the overall raise. So to be able to use off-the-shelf, simple securities like a SAFE or a KISS is great. The security that had been previously used most commonly prior to that is the convertible note. The convertible note is also a pretty good security, but one of the issues that can arise with the convertible note is that every law firm can kind of draft them differently. They're not very simple. We actually just had a situation with a company on 1,000 Angels that was raising a significant amount of money on a convertible note, and actually had, a top-ranked startup law firm draft their note for them. But, upon closer inspection, there were just all sorts of issues and problems with the way the note was drafted. So, with convertible notes, they're not always quite as standard and easy to read as something like a SAFE or a KISS, which now sort of introduces an element of risk that you don't know exactly what's going to happen in the myriad of various scenarios and outcomes that we can see as investors. So, SAFE is great. Probably that would be one of the preferred instruments, but the other two are fine too. Just remember that if you are in a convertible note, all of these you're going to have to look at very closely. A convertible note, you're probably going to have to look at the most closely because it's the least clear. And so the types of investors that you're going to see in a seed round include usually angels, angel groups, super angels. So there are some angel investors, that actually kind of just do this, very wealthy people, usually older exited founders who maybe just do this full time and will write checks of kind of $100,000 to $250,000 into each company and maybe invest in, 5 or 6 companies per year. Or angel groups, which are similar to 1,000 Angels, but not really. Most angel groups are really formed kind of on the premise of that it's an opportunity for people to sort of get together and have breakfast and chat and, talk to founders. They can be a really wonderful experience for the members if the person is so inclined, but they can be a little bit frustrating for founders in that, rather than dealing with one person who's helping to make a decision and helping you to raise your capital, you're now kind of dealing with, maybe 50 to 100, sort of unknown personalities who are going to take up a lot of your time. So that's a little bit of the difference, between a traditional angel group and something like 1,000 Angels, where we provide a much more streamlined process around connecting capital between founders and investors to minimize the amount of time that both sides have to invest and to make it as efficient as possible. And then, of course, the next most important participant in this stage of funding are seed funds. So, there aren't tons of seed funds out there. There are a few, and the people who manage these usually have to work very hard because if you kind of understand what a fund model is, almost all funds work on what we call the 2 and 20 model. So the people managing the fund get 2% a year of the assets they deploy in the fund, and then they get 20% of the profits. So the reason that seed funds are a little bit harder to find, investors at this stage are a little bit harder to find than those at Series A, is because investing in a company at seed stage involves a lot of work, but because there's not a huge amount of money being put to work, the investment managers aren't really compensated that much financially. So it's a lot of work for relatively little near-term reward, but seed funds really play a very important component in this community by helping to put more people into the ecosystem who actually have a professionalized approach to making these investments. And these funds are so valuable to you as individual investors because when you're co-investing with a fund, you know that the investor class is going to be professionally represented, right? And you know that there are additional resources that are being brought to bear on the startup's growth in a much more professional manner, as well as the most important thing, which is helping the company get from seed to Series A. So if we go on to the next category, generally for a Series A and Series B, there is one type of security that's being used, and that's what we call preferred equity. So I think that something that's interesting to just be aware of in this particular segment of the finance world is that the way that we look at convertible notes and preferred equity is really very, very different from the way that a corporation that issues a convertible note or preferred equity is issuing them, right? So actually in the corporate world, I used to be a bond trader, have my MBA. I sort of have a lot of experience in various asset classes, and the traditional, corporate issued preferred equity is actually a instrument that's meant to replicate a bond, but with different sort of tax implications. So if you're kind of thinking about that in your mind, because that's what most people would be most familiar with, that has nothing to do with this security, right? So this security is very much equity. The reason that it is preferred is because we want to basically differentiate between investors who have put cash into the company and investors who have put sweat equity into the company, right? So if you're an investor who's put, let's say that as a class, we're investing $1 million into a company that has a $4 million pre-money valuation. So those investors own 20% of the company and the founders own the other 80%, right? Because we put $1 million in and there's a post-money valuation of $5 million. So the reason that we want to separate our equity as preferred versus theirs as common is so that we can protect ourselves by saying, well, whatever happens to the company, we basically get our $1 million back first, plus maybe some kind of preferred return, right, which could be expressed as a dividend, before the common shareholders get anything. And the reason that that's so key to protect investors who are actually putting money in is that, if somebody starts a company, they, sell 20% of the company for $1 million, and then, the $1 million is sitting in a bank account, those investors own 20%. If they decide to liquidate the company tomorrow, technically, if you were in common stock as investors, you'd only be entitled to $200,000 of the cash there, and the founders could walk away with the other $800,000. So really the reason we structure it is to reflect that, right? Which is that, investors should get their money back, and then everybody can kind of share in the rewards. And so at Series A and Series B stage, typically the investors who are here, and really only the investors who are here, are venture capital funds. So you're never really going to see, a company that got a Series A done by, angel investors. And I think that this drop off is why, one of the things I really try to explain to our individual investors, as to why making investments through an organization like 1,000 Angels is so valuable, right? Which is that you're not going to see angels be able to get into this Series A or Series B. And so actually, where the vast majority of wealth and risk-adjusted returns are created is at the Series A and Series B. So I just want to be very clear that at the seed round, which is where we start investing, the absolute expected returns are higher, but at the Series A and Series B, the risk-adjusted returns are much higher, in my opinion. And this is where you see venture capital firms getting involved with a company. But the issue is that if you're not already on the cap table, if you're not already an investor, they're generally not going to let you start investing at Series A or Series B. So this is where we come in to help you guys, right? So by me sort of doing that work, right, our team doing the work to develop the relationship and to make the investment at the seed round, we now have usually an excellent relationship with the founder. So by the time they get to the Series A and Series B, there is an opportunity for the investors who came in at seed to put more money in, and sometimes even for some new investors in our group to put more money in. And that's sort of the benefit of being part of this group, is that, through this relationship, we're sort of able to get access into this, sort of high expected return, very attractive risk-adjusted return asset class of the Series A and Series B investments that typically you could only get access to if you were in a venture capital fund. And so the big difference between a venture capital fund and 1,000 Angels that makes this an interesting way for you to execute the strategy more efficiently, given that you're a high net worth individual, is that we are able to place your investments directly. So if you invest in a fund, you have to pay, 2% per year in management fees. And you also have to provide the investment manager with 20% of the gains on the overall portfolio. Thirdly, you really don't have any control of what companies the investment manager invests in once once you've committed to the fund. And then lastly, I think one of the, and I think there's nothing wrong with funds. Funds are amazing too. They just like everything has its own cost. But most importantly, for some people, being in a fund can be a little bit tricky in that, when you make an investment in a fund, the minimum investment commitment is typically at least $250,000, and that would really just be for like friends and family. And basically, you're now committed to investing that $250,000, over the next. They're going to draw it down over maybe the next 3 or 4 years, probably like 3 years. So, with something like this, with 1,000 Angels, you have much more flexibility in that, there is no capital commitment. So if this year you decide you want to invest 100,000, great. If next year, you have to make a college tuition payment you weren't expecting or something, and you want to invest zero, that's fine. And then if the next year, you get an exceptionally large bonus and you want to invest 200,000, that's also fine. So the flexibility is something that, has a ton of economic value as well, because, for example, right now, some people might be freaking out about the market, being down. If you're invested in a fund and they make a capital call, you have to put that money in no matter what, right? It doesn't matter, if the world is falling down around your ears, you're stuck in that commitment. So that's a little bit about the middle category, which is what we're really trying to get access to by coming in early and doing what I call purchasing a very cheap option in these companies at the Series seed stage. So once the company gets through an A and B, and usually Series A rounds are typically between like $3 and $5 million. A Series B is usually like a $10 million raise. And then, Series C and on, usually the company's raising about like 25 million at a clip. And so this can be done still in preferred equity. It can be done with something called mezzanine, or it can be done as debt. I mean, these private equity companies and investment banks can structure the investment in a variety of creative ways. And eventually what the company is usually hoping to do is either to get to an acquisition or to get to an IPO in the public markets, right? So once they've sort of gone past, sort of taking in the private equity money where people are looking for sort of like 2 or 3x returns, they eventually will, go public or sell themselves to a much larger company. And then at that point, if they go public, the new owners of the company are investment managers of pension funds, life insurance funds, much larger portfolio companies. So I hope that this chart helped you kind of understand the financing life cycle. And so where we come in, which would be, sort of at the Series seed round, hopefully with follow-on investments in the A and the B round, depending on what the price is. And, certainly one of my roles is to help you guys evaluate whether or not the price in one of those subsequent rounds is still attractive enough for you to want to put more money in. And then, of course, helping the company get to the point of a Series C, D. We actually had, I think Stash, which was one of the companies on 1,000 Angels when we first started, is on its Series E. So they can, there can be a lot of rounds and a lot of money changing hands while a company is still private. And then by the time it's getting either to, a liquidity event for you, which is either, a private equity company coming in, buying out the original investors, a larger company coming in and doing an acquisition, or if the company has an IPO, you're getting liquidity there. So we're seeing you kind of come in at seed, Series A or Series B, and then, be able to actually achieve a return on your investment in Series C, Series D, or an IPO. So I hope that answers some of the questions that you have about, what exactly we're investing in with 1,000 Angels and what the end goal is. One of the things I think is really important to also have an idea of is, the targeted expected return at different stages of investment. So typically when a company is doing a seed round, we're really looking for what we would call kind of a 20 to 40x on the investment. At Series A, you're, kind of at like a 15 to 20x expected return. B, is now maybe sort of 7 to 10. By the time companies get to Series C and D, those investors there are looking for more like a 2 to 3x return on their investment. And then when a company gets into the public market, every company has a different cost of equity capital, but traditionally public market returns are around 7% per year. So that can give you an idea of, what what the returns are hoping to be at different stages, or at least what we demand at different stages that the founders aim to provide us. So I want to thank everybody who joined today, and I am just going to really quickly check in and see if there were any questions along the way. Okay, great. So we don't have any Q&A right now. So I hope you all enjoyed this. If you'd like a copy of the slides, please email me at erica@1000angels.com, and I'm happy to answer any questions. Mary, I see that you raised your hand. Hi, Mary.
Can you tell us a bit about how to get involved with 1000 Angels?
Yeah, sure. So if you go to 1000angels.com, you can submit an application for membership, and I'll set up a one-on-one conversation with you.
Okay, thank you.
Thank you. All right, I want to thank everybody for coming. And, as I said, visit 1000angels.com, email me at erica@1000angels.com, and I look forward to seeing you soon. Bye.